Over the last few months, we've spoken a lot about the impact auto loan delinquencies and repossessions are going to have on the used car market. Because once it does occur in full force, it will increase the supply of used cars in the market, thus decreasing the price of used cars around the entire country.
We have got the new auto loans data that shakes up the entire car market. Debt levels have soared to an all-time high, cars are depreciating faster than ever, and millions of Americans now owe more on their loans than their vehicles are worth. This has created a financial trap for countless consumers and threatens the stability of the entire car market. But how does this affect you? Whether you're in the market for a new car, already have an auto loan, or are just watching the economy, the consequences are far-reaching. So why are cars losing value so quickly? How did loans get so inflated? And is there a way out of this mess? The real reason behind this all will shock you. The rise of auto loan debt. In recent years, auto loan debt in the United States has reached a staggering $1.5 trillion, a record high that paints a concerning picture for consumers and the broader economy. This massive debt load has more than doubled in the past decade, signaling not just an increase in car sales, but a profound shift in the way people are financing their vehicles. What's even more troubling is the growing amount of negative equity, the situation where consumers owe more on their vehicles than they are worth. The average consumer is now underwater by approximately $6,450, and some buyers are facing loans with negative equity exceeding $150,000. This situation has created a financial strain, leaving many consumers trapped in a cycle of debt that is difficult to escape. But how did we get here? Why are consumers finding themselves owing more than their cars are worth, and how is this affecting the car market? These are the questions at the heart of this crisis, and they require a deep dive into the factors driving this unprecedented surge in auto loan debt. Why negative equity is exploding. The fundamental issue at the core of this auto loan crisis is negative equity, which happens when a vehicle depreciates faster than the loan is paid off. Historically, this wasn't much of a problem because cars typically lost value slowly and predictably. However, over the past few years, vehicle prices have been artificially inflated due to a combination of supply chain disruptions, increased demand for trucks and SUVs, and dealer markups. A prime example of this can be seen with a popular vehicle such as the 2024 Ford Bronco. Initially priced around $55,000, these vehicles were in high demand, but often carried $10,000 or more in market adjustments added by dealerships. On top of that, consumers were faced with additional charges for things like paint protection, nitrogen-filled tires, and window tinting, costs that were often bundled into the final price of the car. A vehicle that should have cost around $55,000 could end up being sold for $70,000, putting buyers into loans that were much higher than the actual value of the vehicle. The real problem starts when these inflated car prices start to drop. As supply chains improve and more vehicles become available, those inflated prices begin to fall. Now, that same Bronco, once priced around $70,000 with dealer add-ons, may be available for closer to $50,000, leaving the buyer who financed that original $70,000 loan deeply underwater. Even though they've been paying off their loan for a year, most of their payments have gone toward interest rather than reducing the principal, meaning they still owe a large amount on a vehicle that's worth far less than what they paid for it. The role of interest rates and loan terms. Another factor contributing to the rise in negative equity is the structure of auto loans. Over the years, loan terms have lengthened, with many consumers now opting for 6 or 7 year loans to keep their monthly payments lower. While this might seem like an attractive option at first, it creates a situation where borrowers owe more than their vehicles are worth for a longer period. Additionally, as interest rates have risen, more of the monthly payment goes toward paying interest rather than reducing the loan balance. For example, someone who finances a $70,000 vehicle with a 6-year loan at a high interest rate may still owe close to $65,000 a year after making 12 months of payments. This prolonged debt cycle means that even if car prices drop, many consumers are unable to escape negative equity. The reality is that most car buyers are not putting down large down payments. For many, the idea of putting down more money up front is out of reach. Instead, they rely on financing to purchase vehicles, which exacerbates the problem. Buyers may feel they're paying for a car that has already lost significant value by the time they drive it off the lot, leaving them stuck with debt that is hard to manage. The impact on dealerships. This growing crisis is not just affecting consumers, it's also having a profound effect on car dealerships. In the past, trade-ins served as an essential part of a dealership's inventory. Customers could trade in their old vehicles, and the dealership could then resell them using the trade-in value as a down payment for the next car. However, with so many consumers now underwater on their loans, trade-ins have become less of an asset and more of a liability. Imagine a consumer who bought a vehicle for $70,000, financed through a loan that put them underwater by $10,000. When they try to trade it in for a new car, the dealership may find itself stuck with a car that's worth far less than what the consumer owes. As a result, the dealership has to either offer less money for the trade-in, or in some cases turn down the trade-in altogether. This lack of available trade-ins further compounds the problem, making it even harder for dealerships to move vehicles and maintain sales volume. Dealerships are now finding themselves in a situation where they need to sell cars, but the existing inventory is tied up in negative equity. With fewer trade-ins available, dealerships are forced to turn to new buyers who may also be struggling to secure financing due to high levels of existing debt. This has created a market where, even though there is demand for cars, the financial structures aren't in place to support a healthy sales environment. The growing concern of repossession. As consumers struggle with negative equity, repossessions are becoming more frequent. In fact, repossession rates have increased by over 23% in the last year. These repossessions are not just happening at luxury dealerships or with high-end cars. They are affecting buyers at all levels of the market. What's even more alarming is that these repossessions are often not reported, especially when they come from smaller buy here, pay here dealers who deal with subprime borrowers. As these repossessions increase, it creates a vicious cycle. The cars being repossessed are often worth far less than the loans attached to them, and once the car is resold at auction, the consumer is still left with the remaining balance on their loan. This only increases the amount of negative equity in the market, making it even harder for buyers to purchase new vehicles. The rise in repossessions also signals a greater issue. Many consumers are simply unable to keep up with their loan payments, even with relaxed lending standards. As more buyers default on their loans, it creates a backlog of repossessed vehicles flooding the market, driving prices down even further and making it harder for dealerships to maintain profitability. Trapped in a financial loop. The auto loan crisis has left many consumers caught in a cycle of debt that is difficult to escape. As negative equity rises, buyers find themselves owing more than their vehicles are worth. The situation is compounded by longer loan terms and rising interest rates, which together make it increasingly difficult for consumers to get out of debt. In the past, consumers could rely on the value of their trade-in to act as a down payment when purchasing a new car. This system worked because vehicles, while they depreciated over time, did so at a predictable rate. However, with many consumers now deeply underwater on their auto loans, the idea of trading in a car to offset the cost of a new one has become increasingly unrealistic. For many buyers, this financial loop leads to an endless cycle of borrowing to pay off loans on cars that continue to lose value at an accelerating pace. To illustrate the problem, consider the example of the 2024 Ford Bronco. A consumer may have purchased this vehicle for $70,000 with a loan that placed them at a significant disadvantage in terms of equity. A year later, that same vehicle could now be worth $50,000 at the dealership, but the consumer still owes around $65,000 on the loan. The buyer may have made monthly payments, but those payments were largely directed toward interest rather than the principal balance. This leaves the consumer in a difficult position, where even if they wanted to sell or trade in the vehicle, they would still owe a significant amount of money. In many cases, the situation becomes even more complex as borrowers attempt to trade in their vehicles or purchase new ones. With the value of the vehicle continuing to drop and the debt remaining high, the consumer often faces a daunting task. They need to come up with a large sum of money just to pay off the difference. For many, this simply isn't possible. The financial strain of being so far underwater often results in defaults, bankruptcies, and a long-term impact on credit scores, further exacerbating the problem. As negative equity grows, repossession rates have been rising at an alarming rate. In fact, reports indicate that repossession rates have increased by 23% over the past year. While repossession numbers are often reported by large financial institutions and major banks, the true scale of the issue is likely much higher, as smaller dealerships and subprime lenders are not required to report repossessions to the same extent. For consumers, repossession is not just a financial setback, it's a life-altering event. When a car is repossessed, the borrower borrower is left with no vehicle and a large amount of outstanding debt. In some cases, the car that was repossessed is worth far less than the loan attached to it, leaving the borrower with the remaining balance to pay off. This not only damages the consumer's credit, but also further entrenches them in a cycle of debt. For those in lower income brackets or with less financial flexibility, repossession can be a devastating blow. What makes this situation even worse is that many consumers find themselves unable to refinance their loans, even as interest rates begin to stabilize. With the car's value declining and the remaining loan balance still high, refinancing becomes impossible for many borrowers. Banks and financial institutions may be willing to lower interest rates, but they are less likely to offer refinancing options to borrowers who are deeply underwater. As a result, many consumers find themselves stuck with loans that are unmanageable, unable to secure financing to purchase a new car, and facing repossession if they fail to meet their payment obligations. The burden of rising interest rates have been steadily climbing, and while they are a normal part of the economic cycle, they have had a disproportionate effect on the auto loan market. As interest rates rise, so do monthly car payments. This has further strained consumers who are already dealing with negative equity. The higher the interest rate, the more money consumers pay over the life of the loan, increasing the overall debt burden. Many buyers, especially those in subprime categories, are finding that they simply cannot afford their monthly payments as interest rates climb. The situation is even worse for consumers who bought vehicles at inflated prices during the pandemic or when supply chains were disrupted. These buyers, who may have financed vehicles at interest rates of 5, 6, or even 7%, are now faced with much higher monthly payments due to rising interest rates. Even if their financial situation has improved slightly, the higher monthly payments create a financial strain that is difficult to overcome. For some consumers, the combination of negative equity and rising interest rates means that refinancing is not an option. Even if they could reduce their interest rate, the amount they owe on the vehicle is still far higher than the car's current value. So even though they may be able to lower their interest rate to a more manageable level, they are still left with an unsustainable loan balance. This leaves them facing either default or long-term financial hardship. The shrinking pool of trade-ins. One of the most important factors for consumers when purchasing a new car has always been the ability to trade in their old vehicle. In a healthy car market, trade-ins offer buyers a way to reduce the upfront cost of a new vehicle, essentially using the equity in their old car as a down payment. However, as more consumers become underwater on their loans, the pool of available trade-ins has shrunk. Dealerships that once relied on trade-ins to stock their inventory are now finding themselves in a tough spot. Consumers who owe more on their cars than they are worth are unable to offer trade-ins that reduce the cost of their next purchase. In turn, dealerships have fewer used cars to sell and are unable to replenish their inventories in the same way as before. This lack of available vehicles for resale puts further strain on the market as dealerships turn to new cars to maintain their sales numbers. This lack of trade-ins is also impacting the used car market. Without enough trade-ins, dealerships are forced to rely on other sources, such as auctions, to replenish their inventories. But as more vehicles become repossessed, those cars end up in the same auction pools, driving prices down further. This creates a ripple effect throughout the market, where used cars become less affordable for buyers, and dealerships are left with fewer vehicles to sell. Financial strain on banks and lenders. For financial institutions, the rising levels of auto loan debt are a double-edged sword. On one hand, they make money by issuing loans, but on the other, they face increased risk as more consumers fall behind on their payments. Banks and other lenders are being forced to adapt to a changing landscape where defaults and repossessions are becoming more common. As repossession rates climb, banks are left with large amounts of debt that are difficult to recover. To mitigate these risks, some lenders have started relaxing their lending standards, approving loans for consumers who may otherwise have been denied. While this may temporarily boost sales, it also increases the risk of future defaults. This creates a dangerous cycle where banks are issuing more loans to consumers who cannot afford them, which will only lead to more repossessions and more negative equity down the line. The industry's response. As the auto loan crisis continues to deepen, both dealerships and banks are feeling the pressure. Dealerships are caught in a difficult position. Demand for vehicles remains strong, but the affordability of cars has plummeted and the availability of trade-ins is drying up. This leaves dealerships struggling to maintain sales while also managing the growing inventory of vehicles that consumers no longer want or can afford. Dealerships typically rely on trade-ins as part of their business model, using them to fund new car purchases for customers. However, when customers owe more on their vehicle than it is worth, the trade-in no longer works as it once did. With a growing number of customers underwater on their loans, dealerships are finding themselves in a position where they cannot offer sufficient trade-in values to entice buyers. Some dealerships have adjusted by offering massive discounts on new inventory or even resorting to aggressive pricing tactics to clear stock. However, these strategies only provide temporary relief. In many cases, dealerships are being forced to offer cars at prices below cost, especially as new car production is backlogged and used car inventories surge. This situation is unsustainable in the long term, as it compromises profitability, and without a solution to the growing negative equity problem, dealerships may struggle to maintain a steady flow of sales. Banks, on the other hand, are increasingly willing to ease their lending standards in an attempt to keep the car market moving. As interest rates rise and consumers face financial strain, many banks are lowering their criteria to ensure more loans are approved. While this strategy might help boost car sales in the short term, it raises significant risks. Consumers with poor credit are being approved for loans on cars they cannot afford, which only exacerbates the growing negative equity problem. And the ultimate goal for banks is to lend money in order to generate profits. But the current environment is challenging. Consumers who are already deeply in debt often cannot qualify for loans, and with many vehicles rapidly losing value, the risk of repossession is growing. However, if banks continue to relax their standards, they could end up in a situation where default rates skyrocket, leading to potential financial instability. These high-risk loans may provide short-term profits, but the long-term consequences could be catastrophic for both banks and consumers. The role of automakers. Automakers are also facing pressure to adapt. Traditional car manufacturers are not immune to the issues facing the broader auto market. Companies like Ford, General Motors, and Stellantis have seen their market share slip as high car prices, inflation, and negative equity push consumers toward more affordable alternatives. This shift is especially noticeable in the electric vehicle market, where Ford's F-150 Lightning and the Mustang Mach-E have struggled to meet sales expectations. One major challenge automakers face is the high price of manufacturing vehicles. As the cost of raw materials rises, automakers are forced to pass those costs onto consumers, which only makes vehicles less affordable. While automakers have been investing in electric vehicles, the price point for these vehicles remains relatively high, which means the average consumer cannot afford them. Automakers must find a way to balance their efforts to innovate with the reality of the current market. They are caught between advancing the technology for electric and hybrid vehicles while also catering to a market that is heavily price sensitive. If they continue down the path of high-priced, tech-heavy vehicles, they risk alienating a large portion of the consumer base. However, if they lower prices, they may not be able to maintain profitability, especially as they shift production to electric models that require significant investment in new manufacturing processes. Additionally, automakers will need to address the challenges created by negative equity and its impact on trade-ins. As more consumers are underwater on their loans, automakers must find ways to adjust their pricing and financing options to ensure that people can afford to make the switch to new vehicles. This may involve offering incentives, subsidizing down payments, or restructuring loan terms to help ease the burden of negative equity. What needs to change? The auto loan crisis is not something that will resolve itself without intervention. Dealers, lenders, and automakers all need to be more proactive in addressing the core issues that have caused negative equity to rise to such extreme levels. One potential solution is for automakers to introduce more affordable vehicles, particularly electric vehicles, at price points that consumers can afford. While electric vehicles are often seen as the future of the automotive industry, their high price tag remains a major obstacle for most buyers. By offering lower-cost EVs that are closer to the price of traditional internal combustion engine vehicles, automakers can help ease the financial burden on consumers. This could drive greater adoption of electric vehicles while also addressing the affordability gap in the market. Banks also need to be more careful about the loans they approve. While relaxed lending standards may keep the market moving in the short term, they increase the risk of defaults and repossessions. Banks should focus on providing loans to creditworthy consumers and ensuring that they are not contributing to the problem of negative equity. By being more selective and focusing on long-term stability, banks can help avoid a much larger crisis down the line. Finally, the car market as a whole needs to find a way to bring the price of cars down to a more sustainable level. This could could involve reducing production costs, eliminating unnecessary add-ons and dealer markups, and finding ways to increase vehicle lifespan so that consumers aren't left holding loans on depreciating assets. With fewer people able to afford new cars, automakers, dealers, and banks must work together to ensure that the car market remains healthy and that consumers can make purchases that are financially sound. The big picture. The auto loan crisis has exposed deeper issues in the economy, and it's clear that change is needed. For consumers, the key is making informed, responsible financial decisions. It's no longer just about the monthly payment. Rising interest rates, longer loan terms, and increasing car prices mean understanding the full cost of ownership is essential. Car buyers must consider depreciation, interest, and how much they will owe at the end of the loan term. For many already trapped in negative equity, refinancing might seem like a solution. However, refinancing does not address the core issue: cars losing value faster than the loan is paid off. Refinancing just shifts the debt, and many borrowers find themselves stuck with unsustainable loans. Instead, consumers should focus on saving for larger down payments, avoiding extended loan terms, or opting for used cars that have already depreciated. While these may not seem glamorous, they are practical ways to avoid further debt and regain control of financial futures. Recognizing when financial limits are being overextended is crucial. The temptation to buy new vehicles based on emotional appeal or social pressures can lead to over-leveraging. Practically approaching car purchases, focused on long-term stability rather than immediate desire, will help consumers avoid sinking deeper into financial trouble. The issue, however, extends beyond just consumers. The rising consumer debt levels in the United States, with auto loans now accounting for a significant portion of non-mortgage debt, reflect a broader economic challenge. This systemic issue affects not just the auto industry, but the entire financial ecosystem. As car prices continue to rise and more consumers remain trapped in negative equity, this financial strain could deepen. This crisis signals that we need a shift in how we approach debt. Automakers need to provide more affordable options, especially in the electric vehicle sector, where prices remain high despite growing interest. Dealerships must reduce inflated markups, and banks need to return to responsible lending, focusing on long-term stability over immediate profits. Consumers, too, need to make more informed purchasing decisions that align with their long-term financial health. The broader economic impact is undeniable. The current situation highlights unsustainable spending and debt reliance, both in the auto industry and the wider economy. To solve this, the auto market needs collective action from all parties involved. Only by addressing these issues holistically can we restore balance to the system and protect consumers' financial well-being. Thanks for watching, but what's your thoughts on this? Let's know in the comments down below.